Welcome. Today's lesson comes to you from Lisbon, Portugal. I believe this is Lisbon. So it's a very brightly colored looking place. Lots of water, bridges. Okay, today we're going to be talking about the statement of cash flows, the direct method. So we're going to be looking at how we produce this financial statement. And it's a little bit tricky, so you better be paying close attention. Whoops. Here is the rubric. So this is under resources, okay? And the good news is we just have a few lines to worry about. This is only one part of it. So this is the operating section, okay? Statement of cash flows actually has, it's got just really three sections to it plus a reconciliation. So the three sections, and this is direct method we're going to be looking at first. And the first section is the operating section. So all the items that are in the income statement should show up in the operating section. So it's usually income, expenses, things like that. And we're only looking at cash flows here. The investing section has buying and selling capital assets, loans the company makes, and money it gets back, investments the company makes, money it gets back. Financing section is money coming and going from loans, bonds, stock, dividends paid, things like that. At the bottom there's a small reconciliation. You look at the change in cash for the year plus the beginning balance should equal the ending balance, so we can check that in the balance sheet. Okay? So what we're going to do is take a look at just a couple items here. Oops, I probably should fill in a few more. We don't have any interest. Oops. And there's the last one, cash paid for taxes. And that'll give us a total. Okay, so the first one, here we go. Cash received from customers. How are we going to figure that one out? Well, we're going to take a look at, as I find it here, we are going to take a look at, oops, wherever it is. Oh, McGraw-Hill. There we go. Fort & Company, problem 12-1A. So if you remember the little sheet, or cheat sheet here, we've got net sales plus any decrease in accounts receivable, or minus any increase in accounts receivable. Why is that? Well, because if accounts receivable goes up, that means somebody didn't pay us. They just owe us. So it doesn't help us to, get money in. If accounts receivable goes down, that's probably a good thing. That means extra people paid us money, right? All right. We're going to take a look at Fort & Company. So we're starting with sales of $582,000. All right, 500. And then we have to look at the change in accounts receivable. It went from, here's 2012, 50,600 to 65,800. So accounts receivable increased. So it's bad from the standpoint of cash flows, right? So what do we have here? So we're going to put in our sales amount first, and sales was 582,500. And then we're probably going to end up subtracting. And the two accounts receivable numbers were, let's see, we had a net decrease, so we subtract the decrease. 65,810 less 50,625. If we put that together, we actually received $567,315 in cash. Okay? So that's sales less the decrease, or the increase, in accounts receivable. All right. Next one, there was no interest or dividends that I remember in the income statement. Here's our income statement. No interest, dividends listed separately, so we're good. Our next line is cash paid for purchases. So here we go at cost of goods sold, then plus any increase in inventory, or minus a decrease in inventory. So we have to find the change in that first, plus any decrease in accounts receivable. So the more accounts receivable goes down, it goes down because we wrote checks. So more payments going out. or minus any increase in accounts receivable. Accounts receivable goes up, that means we didn't pay people, so we're paying out less money for that. So let's see what we have. Oh, pretty tricky, huh? Alright. Oh, we started with, what did we start with? Oh, cost of goods sold. Cost of goods sold were, oops, I want that one out of here. And I want this one out of here. Cost of goods sold were $285,000. And if you take a look at, what's our next two? Inventory. Inventory went up. Looks like about $24,000. So inventory going up is going to increase the amount of money we spent, so it's a plus. Accounts payable went down, so accounts payable going down, that's also going to increase the amount of money we spent. Okay? So let's try that out here. So let's see how it works. We're going to start with, what are we going to start with? Cost of goods sold, $285,000. I believe the correct amount. Yep. Looking good. And then we said plus, because inventory went up, so it's going to increase our cash flow. And the change in inventory was $275,656 minus $251,800. Okay, that's going to account for the change in inventory plus the change in accounts payable, and they decrease, so that's an add. Okay, add. Accounts payable decrease is a plus, so we're going to add that. And how much was that one? Let's see, that was $114,675 less $53,141. Time is flipping by here. Looks like I'm coming up with, whoops, and that goes down here actually. Cut that guy, put in the wrong line. Alright, oh, $370,390. Alright, so this was actually zero here. So that's our change for purchases. Okay, cash paid for expenses. It's another tricky one. All of our operating expense. Then we're going to add back any depreciation or amortization or depletion. Then we have to look at our prepaids. I think we only had a little bit of that. If prepaids go up, that's an increase in our cash payments. And then we look at accrued liabilities. If they go up, that's a decrease in our cash payments. If they go down, that's an increase. So let's see what we've got for that one. And I think we just have a little bit here. So our operating expenses, so here we go, operating expense. So we've got $153,150. Okay. Then we're going to have to add back depreciation, $20,750. And we do have some prepaids. It looks like they went down about $600. So prepaids going down is going to be a minus in our payments, and we're not showing any other liabilities here that we can deal with. So everything else over here is going to be part of financing or investing. Okay. I wish I could do the whole thing. I probably won't have a chance to do that. I'm running out of time. So our what was that? Oop, I forgot. Our operating expense was $153,150. Okay. To that, we're going to add depreciation back, $20,750. And then we said our prepayments went down, so that's going to be a minus, and that was $1,875 to $1,250. All right, and it looks like we're coming out with, oops, the wrong number. Did I do that one right? $173,153. Oops. Oops. Wow, that doesn't look good. What did I get here? 130. Oh, I'm sorry. I'm going to subtract depreciation. See, that will make it work. Hold on. There, 131,775. Oops. Minus depreciation. Sorry. Okay. Well, we're good here. So those are like the first three items, and I'm running out of time. The only other one we would have here is, I think, cash paid for taxes, which would be, what would that be? That would be the income tax expense plus any decrease in accrued taxes minus any increase. Do we have any of those? Let's see. Income tax expense 24,250, and we have no tax accruals payable here. So just 24,250 is our cash paid for taxes. Okay. So in the end, our total cash provided by operating activities are going to be, it's going to look like this. So it's going to be equal to our 567 minus the cash paid for purchases, minus the cash paid for expenses, minus the cash paid for taxes. Looks like $40,900. And that is it. Thanks for listening.